Hi, my name is Jan Owens. I am co-founder and CFO for Accountant. At Accountant, we serve as the outsourced accounting department for A&E firms. We provide the bookkeeping, accounting, financial reporting, and strategic advisory for firms so that they can gain better visibility, make more informed decisions, and improve profitability in their firm. And today I'm talking about blind spots to bottom line and how project costing can improve your firm's profitability. I am a two-time CFO of the Year award winner in the Portland, Oregon area. And I'm going to jump right in on the second part of a two-part series. And yesterday I talked about the visibility you gain from project costing. And today I want to talk about how you use that visibility to improve the profitability in your business. And I'm also going to touch on why profitable firms still have cash flow issues and give you some practical advice on ways where you can improve cash flow within your firm. So you can use project costing to help identify the most profitable projects and project types, because not all projects generate the same return. So knowing what type of projects are the most profitable helps you pursue more of that work to drive the best results within your firm. And I have an example for you. I have a client, a 12-person civil engineering firm, and they believed that their municipal projects were more profitable than their private projects. And after implementing project costing, they realized that their smaller commercial projects generated profits on average of 68%, while the larger municipal projects only generated a gross profit average of 52%. And why? They could look through project costing and they realized that the municipal projects required more time. They required more meetings. They had more change orders. They had special reporting and invoicing requirements, and all those things were not counted on or not considered when the estimate was being put together for the project. And so as a result, they shifted their marketing efforts towards gaining more commercial work. And for future municipal projects, they raised their pricing to accommodate for the extra time required. Project costing also helps you improve your fee estimation accuracy. So you may discover that certain project types are consistently underestimated. And that insight creates opportunity for coaching your estimators, putting together better assumptions and more accurate proposals moving forward. So in that same example that I just gave regarding the municipal projects, project costing helps you provide that feedback loop to your estimators so that they can make better, more informed decisions moving forward. Project costing also helps you spot consistently underperforming clients. If you have clients that you do work with over and over again, you will find that once you have project costing visibility, there are trends with certain customers where you have higher margins and other customers where you have lower margins. I have an example with a structural engineering company who had a client that they loved working with. They'd worked with them for about 10 years, but the project costing, when they put it into place, indicated that the project's average gross margin on their projects was only 40%, while the firm's average was 62%. And the reason why, once they dug into it, when they had the data, they realized that the client frequently requested revisions, but they very rarely approved change orders. So they ended up over-delivering and not being able to invoice for the work. So the firm, as a result, implemented stricter scope management and a process for pausing on change orders. So they did not do the work until the approved change order was received, and it significantly improved the profit margin for that client, and they were able to retain that client. Profit margin also helps you detect scope creep earlier, and small changes can very quickly add up, and it erodes your profitability. So the sooner you identify scope creep, the easier it is to address it and course correct. Project costing also helps you improve staffing and resource planning. So knowing where projects stand helps you put the right people on the right projects and avoid overstaffing or understaffing. Another way that you can use project costing is to increase project manager accountability. When project performance is visible, project managers can make better decisions and take ownership of project outcomes. Without project costing, they are operating in a vacuum. They have no idea how things are going oftentimes until the project is completed. And at that point, it's too late to do anything about it. I have an example on that one where one of our firms started sharing project costing with the project managers at the end of every month. They would give them a estimate versus actual report, and it was broken out by their internal labor, external labor, things like reimbursables and other fees. And they were able then to actively use that information to course correct projects. Within a 12-month period, the percentage of projects that met their profitability targets internally improved from only 50% of projects meeting the target to 80% meeting the target. Project costing can also help you strengthen cash flow management and forecasting. Knowing what's likely to be billed and collected helps you forecast cash better and anticipate surprises. So instead of reacting to a cash shortage, you can actively plan for it. So now that I've talked about a few ways how you can use project costing to improve profitability in your firm, I want to talk a little bit about why profitable firms still experience cash flow problems. And one thing I want to point out is that profitability and cash are not the same thing. And this happens a lot where a new client will come to us and they're confused because they say, I'm looking at my financial statements. We're profitable. We're making money, but where is the cash? It's not in the bank. And there's several reasons why that can be. One of the main ones is delayed invoicing. You cannot get paid for work that has not yet been billed. So even a profitable project will create a cash flow challenge if your invoices go out late. We have an architecture firm that when they first came to us, they were only invoicing once a month at the end of the month. So they just piled it all up and did it at one time because they were using spreadsheets. Project costing revealed that some of the phases, after they implemented, some of the phases were being completed 2 or even 3 weeks earlier than when they were being invoiced. But they were waiting because invoicing was a bit of a chore. And so by being able to see, with having a system, they ended up implementing Factor. And by having Factor in place, they were able to see when project phases were complete, and they were able to easily and very quickly invoice as soon as that phase was complete. So what ended up happening is it shortened the amount of time that it took them to invoice and to collect. And the average days to invoice for that particular client actually was reduced by 18 days. Second is slow collections. So profit does not become cash until customers pay you and you deposit that money in the bank. So having things like electronic invoicing, automated reminders, automated account statements, all going out to customers helps improve collections. Collections is absolutely the squeaky wheel gets the grease scenario. So we have a client that implemented all 3 of those things. They weren't doing any of those things. And within 90 days, their average days to collect went from 56 days to 41 days, just by implementing 3 different automated things. It took very little time and effort on their part, but it dramatically improved their cash flow. Another reason is consultant payment timing, and this is a really big one. Oftentimes, consultants expect to be paid before your client pays you, and that timing gap can put pressure on cash flow. So if you are paying your consultants, let's say in 15 days, but you're not getting paid on your projects until 60 days, then you are in essence financing your clients' projects for them. Another issue why profitable firms experience cash flow problems is unapproved scope changes. So work gets done before the change order gets approved, and those additional fees means that they don't get invoiced and they don't get collected. Oftentimes, firms have a rapid growth that they're experiencing, and that growth consumes working capital. So it often requires you investing in people and in other resources before the cash is received and you're able to invoice the client. Oftentimes, it's several months of a delay. So what are some practical ways where you can improve your cash flow in your firm? First off, I recommend you establish clear billing milestones. So define billing triggers in the contract. Make sure your project managers are aware of those triggers and they know when to act. Because if nobody owns the billing trigger, invoices will get delayed and that will affect your cash flow. Invoice promptly and consistently. Many firms wait till month end, as we discussed earlier. So billing immediately when a phase is complete or when a milestone is reached will help significantly improve cash flow as well. Consider paid when paid strategies for sub-consultants. Some consultants may not like this. However, if you are paying your consultants before you've been paid, again, you are financing your client's projects. So don't be your client's bank. If you don't get paid, then they don't get paid. Use a project costing system such as Factor, which will help track paid when paid consultants for you. Once you receive payment from your customer, then they get paid and not before. Integrate your project and financial systems together. When project and financial systems are connected, information flows automatically. It reduces manual work and data entry errors, and it provides real-time visibility into your projects. And you can use that then to make better decisions. So I have an example with a firm who they tracked all of their project budgets in spreadsheets, and they entered their invoices in QuickBooks. They maintained a project status report in a separate system, and then they had the spreadsheets as well. So every month, someone spent hours compiling all of the data, loading it in all the systems, making sure it matched between these systems that did not talk to each other, and then management reports could finally be produced. So after integrating their project management system to their QuickBooks file, project costs, invoices, profitability data all flowed automatically. Reporting time dropped from several days to a few hours, and management could finally view project performance in real time versus weeks after the fact when the data was stale, which then would allow them to act quickly and course correct. And especially when it comes to cash and cash flow, it allowed them to identify early any upcoming shortfalls in cash flow so that they could plan accordingly and strategize on how they were going to attack that cash shortage. So remember, the firms that perform the best aren't always the biggest. They're often the firms that have access to real-time data, and they take action on that data right away. They act quickly. Many owners think they have visibility because they can see the bank balance, they can see revenue, they can see accounts receivable, but those are all financial results. Visibility means you're able to answer which projects are performing well, which projects are not performing well, why, and what are we going to do about it today? And that's the difference between accounting and project costing. Accounting is recording historical transactions. It's already happened. There's not much you can do about a historical transaction. Project costing allows you to see into the future, and it allows you then to make more informed business decisions and influence what happens next. So if you want to learn more about how to maximize profitability in your firm, I have put together a quick 2-minute assessment that you can take, and I'm offering a complimentary profitability maximization assessment report. And if you'd like to meet with me, I'm happy to meet with you as well and go through those results. All you have to do is click the QR code on the screen. And again, it takes about 2 minutes to complete the assessment, and then I'll be back in touch in a couple of days with next steps, which includes insights and some practical advice on things that you can do to immediately impact profitability in your firm.